Oh, I thought we got way further than that.
The last thing I wrote was rental losses and 25,000.
Okay, so when we left off then on Thursday, we were talking about passive losses. So let's just kind of regroup and see if we can remember what we were doing, which obviously that's a struggle for me. What is the issue with rental homes? I mean, if you just have a rental that you, go ahead.
If they're like personal use, like you use it for so many days out of the year, but then you rent it the rest of the time, would that be a timeshare?
No, timeshares are when you buy into using something for vacation, but you don't have any real ownership in it. So I think where we left off was talking about if you have a vacation home that you use partially for rental and partially for personal. And what's the issue there? What are the three things that you look at out of the chute? You've got to categorize it, right? Okay, what's one of the things?
Primarily personal.
Primarily personal. Primarily rental or dual use. Good. So that's the first thing that we have to figure out. Then once we've figured out what it is, we can, Jess, can you hit the light? We can discuss how to handle the accounting for it or the tax prep for it. So if it's primarily rental, no big deal. You get your rental percentage, 78% rental. You multiply that by expenses. That's your rental deductions. Personal percentage, the only things that can go to personal, of course, is mortgage interest and real estate taxes. And those go to your Schedule A. Exactly. Good. If it's dual use, same thing. You get your rental percentage. You get your personal percentage. Personal stuff goes to the A. But what's interesting here is that your rental deductions are only allowed up to your what? Your rental expenses are allowed up to your rental income or revenue. Except for what can throw you into a loss? Interest and property taxes, and that's exactly like our what? Just like our office and home scenario, isn't it? So taxes and interest can take you into a loss situation. Utilities, maintenance, all that other stuff, and depreciation only can take you to zero, right?
You can put a portion, you can put what's left first in the next year.
Certainly. Carry forward, right? We did an example. And then I believe we left off somewhere here talking about categories of income, active portfolio and passive. Active stuff that we do, right? I go earn it. I'm self-employed. I have a business. Portfolio, I own stocks and bonds or REITs, things that generate portfolio income. Passive is something I don't really do anything for, and so the government is going to really limit my passive losses.
So does it mean like if you do want to rent, like if you have, for example, if we were to rent out our house and we were somewhere else, if we had a property management taking
Care of it, yeah.
taking care of that, then that's passive.
So the question is, if I leave town and go overseas for a year and I rent my house and I have a property management firm doing that, is that passive? The IRS calls all rentals passive. So by nature, they're passive. So what does that mean? Passive loss limitations. You cannot deduct passive losses in excess of passive gains. In other words, the IRS doesn't want you going and investing in some limited partnership and generating a couple $100,000 loss and taking it against your W-2s, which is generally most passive activities are higher income taxpayers' tools. Passive losses cannot be used to offset active or portfolio income. This is the key right here. Passive losses cannot be used to offset active or portfolio income.
So let's say you went into a loss because of your mortgage.
Right, so that's what we're going to talk about now. So here we go. Rental property, the IRS specifically calls it passive, even if you actively manage it. So you interview the tenants, you paint in between, you clean in between, you go and collect the rent. It's still designated as a passive activity. So according to what we just learned, technically you shouldn't get any losses. Well, there's an exception. You can take up to what? Remember this? Up to $25,000 of passive losses if it's generated by a rental. Except for if you make over how much a year? 100 grand. Then you start to lose the loss.
Oh, and then you do that half.
$25,000 loss capability is reduced by 50 cents for each buck your modified AGI exceeds 100,000. So if I make 113,000, I'm 13 over times 50 cents. I lose 6,500 bucks of capacity. So the most that I can write off is 18.5. If my loss is only 2, can I write off 18.5? No, 2. If my loss is 20, how much can I write off? 18.5. And we did an example. This gal made 118, her loss was 20. She's over then by 18,000. So 18,000 times 0.5, she loses 9 grand of lost capacity. The most you can ever take is 25 because her modified adjusted gross income is high. She can only take 16,000. Her loss was 20. What does she get? 16. And I think that's where we left it. Quick review. Self-employed health insurance. You guys did this on, I can't remember which client. What is self-employed health insurance? Yeah, I don't have a W-2. Okay, self-employed health insurance deduction, what are the limitations? Well, first off, or what is it? It's all your medical and dental insurance, essentially. Medical, dental, long-term care, all those premiums are deductible. But what's it limited by? This is the big one right here. It's only allowed to the extent of your income. So say that I've got a real side gig, I do hair in my basement, and my net income at the end of the year is, $3,600. And my premiums are 10 grand. How much can I deduct? 3,600. That's basically what it's saying.
What if you got a W-2 on top of that?
If you have a W-2 on top of that, you can deduct your self-employed health insurance, but if in your W-2 you have the ability to be in your company's health plan, then you don't get to deduct self-employed health insurance. So say I work here and then I've got my tax business. I've got the ability to participate in my, University of Montana's health plan. But then say I also pay premiums on my own for dental insurance. It's not allowed in the months where I'm eligible to participate in my employer's sponsored plan. And what is this? Where does this go on your 1040 again? Deduction for AGI, right? We enter it in the Schedule C, which is kind of confusing in the software, but it's not a Schedule C deduction, is it? It goes to the front of the 1040. HSAs. We talked about these in payroll. Anybody remember what they are? How do they work? Good. That's exactly what it is. You put money in pre-tax. It's like an IRA for healthcare. So like my husband's got one at work. And so every paycheck, we take $80 out of his paycheck and we put it in an HSA. and we don't pay any income tax on that $80 a paycheck. Then it sits in this account, and when one of us needs medical or dental or optical care, and we have a copay, we take the money out of the HSA and use that to pay for the copay. How's that a benefit? Tax-free. I earn $1, I pay $1 for my medical care. Okay? Is it tax-free for FICA or just income tax? Just income tax. It's used to pay unreimbursed medical expenses. And the other thing about HSAs, are they a use it or lose it, or do they roll from year to year? That's a flex plan. Flex plans are use it or lose it. HSAs, and the beautiful thing is, say that, God willing, we went, 15 years and didn't need to take any money out of our HSA. When you retire, you can convert it to an IRA. So it rolls.
Do you have to pay taxes on it at that point?
No. No, pardon me. Of course you do, because it was tax-free going in. You're going to be taxed when it comes out. Sure it is.
Even if you roll it.
Yes, you do. Even if you roll it. Yep.
Do you earn interest on the HSA account?
Yes, absolutely. Not much, because they're just, they're bank accounts essentially. So you're getting, whatever these days you're getting, 0.8% or something. But yeah, sure you do. You can only do it though if you are in a high deductible health insurance plan. So he works for the youth homes, and for years they paid the premiums for these really good medical plans for us. And then it just got too expensive. So they did what a lot of employers have done, which is said, we're going to a high deductible plan so our premiums go down, and then you have to start funding an HSA. So you have to be in a high deductible plan, which means at least $2,500 deductible if you're a family, or $1,250 if you're single, and here's your maximum out of pockets. Okay, that's basically that. And where does this show up on your 1040? Should we take a peek at that? I don't know if you've seen that. Anybody remember where that shows up?
Line 26.
What page are you on, hon?
It's look at 1040, line 25, so.
Yep, health savings account deduction. I'll tell you, 5 years ago I had one client with this. Now I say half my clients have them. It's a very common vehicle now.
So your employer can say you have to have a HSA?
Well, what they say is, no, what your employer says is, we're going to a high deductible plan. And you're like, oh my God, my nice little plan that had a $300 annual deductible now has a $4,000 annual deductible. What an employer who's got a good strategy in place will do is say, now we're also going to help you set up HSAs, and maybe we'll put in $50 a month in it, or not. But, so whatever, they're going to help you understand how to use an HSA with a high deductible plan. Okay, so when you take money out of your HSA for medical expenses, you don't pay tax. I don't know, that wasn't your question though. However, if you're over 65 years old, distributions taken for non-medical expenses are subject to tax. And then here's your publication. That means I've got my HSA, I've had it for 10, 12 years. I've built up a $5,000 in it. Now I'm on Medicare. And so I'm going to start taking the distributions from the HSA, like in lieu of an IRA, really, as to live on. And then I'm going to have to pay tax on it. Moving expenses, where do these guys show up? Deduction for AGI. Well, what the heck? Who gets to take moving expenses? Everybody, because it doesn't matter whether you itemize or not. It goes on the front of the 1040. You get to take the cost of moving your personal items in your travel. You got 23.5 cents a mile in 2014. This year, I think it's 23 cents. And they've got to be reasonable. And if they're reimbursed by an employer, then of course you can't take them on your 1040. Well, let's see what form it goes on. Go ahead.
Does cover your moving expenses? Do you have to pay taxes on that?
Nope, not unless it's excessive.
Okay.
So, for example, like when my nephew and his wife relocated from Vegas back to San Antonio, she was a big muckety-muck with a construction firm, and they came in and they reimbursed her something like 10 grand for moving expenses, but she hired the packers and did most of the stuff herself and only spent 4. In that case, she did have taxable income.
You would be the,
Yes. So it goes on, you guys, let's take a look at 3903, and that's at the end of chapter 4. I was hoping I would find one easily. Yep, 4-49. So what do you get? Page 4-49, line 1. Transportation and storage of your household goods and personal effects. So I have 3 cars and I pay somebody to drive one of my cars. Do I get to write that off? I'm moving cross country. Sure. How about the moving van? Sure. How about I have to warehouse the stuff before I can move into my new house? Sure. That's all deductible. Travel, number 2, or line 2. Travel, including lodging from your old home to your new home. All right, so I've got to pay for, I got my mileage for my car. We have to pay to stay because it's a 3-day trip from Massachusetts to LA. Yeah, I get all that. But here's the key. You've got to be moving 50 miles further than how far it was from your old house to your old job.
so if you're not moving for because like with my daughter, she lost her job in Oregon.
Sure, if you're changing jobs, oh, you bet.
Well, she's just going to school here.
No, you have to work 39 weeks out of the next 12 months after the move.
Okay.
So it truly is moving to change jobs. Like when my son left college in Chico and moved to San Francisco, we got his moving expenses. So he went to take a job there. Okay, pretty straightforward. 3903, easy to fill out, nothing fancy. 39 weeks out of the next 12 months. Or if you're self-employed, you have to have clients 78 weeks out of the next 24 months. In other words, they're giving you a little bit more latitude there to start a business.
So if you moved, like, say you moved in 2014.
Yes.
And you worked, but you moved like in the middle of the month, do you not file your moving expenses until you work that full 12 months? So
Well, that's a super good question.
In 2016, you can claim expenses for 2014?
No, that's a super good question. So say you're moving looking for a job in October of 2014, and you come to me to do your taxes in January, you still haven't found a job. What I'll advise you is let's take your moving expenses, but if you don't meet this 39 weeks out of the next 12 months, and you come back to me next year, we're going to have to amend the prior year. Okay, IRAs. We're still looking at deductions for AGI. Front of the 1040, where does our contributions to IRAs go? Page 4-45. Line 32. Deduction to an IRA. What does IRA stand for? Individual retirement accounts. There's 2 kinds of IRAs. This is really important stuff because hopefully you will all be setting these up in the next year or so as you move into your careers. The difference between a traditional and Roth IRA, anybody know?
Roths aren't taxed when they come out. It's after tax dollars that go in.
Close. Traditional IRA, I get that deduction on line 32 and I put my money in. So when I pull it out, I pay tax. Roth is exactly opposite. I don't get any deduction when I put it in, and I pay tax when I pull it out. Or I don't pay tax when I pull it out. Why would you choose a Roth? Or why would you advise a client to choose a Roth? That is absolutely it. If you believe that you're going to be in a higher tax bracket in retirement, this is where you want to go. Who the heck's going to be in a higher tax bracket in retirement? Yeah, but even if you do it all right, are you going to be making more money in retirement than you are when you're earning?
What if you have like a lot of interest income?
Maybe. It's generally for people that are looking to inherit. So I talked to a client, and of course you're never really supposed to plan for inheritances, but in all honesty, my grandpa's got a, 5,000 acre ranch up on the High Line, and he's getting ready to pass, and I'm going to inherit $800,000. So I'm saying to them, you know what, you want to be funding a Roth, okay? Or you do, as Jess said, you have an assortment of other kinds of things, rentals, dividends, or dividend-producing stocks, da-da-da-da-da. You're going to put somebody towards Roth. Most of my clients are, working class folks, trying to get down the road. They want the tax deduction now. How much can you put into an IRA? $5,500 a year earned income, whichever is less. So if I've got a little job and I make $2,000 part-time-ish, I can put in $2,000. 5,500 is the primary number. And if you're 50 or older, you can put an extra $1,000 a year, and it's called the catch-up provisions, to allow people that haven't adequately funded to put in additional amounts. And these amounts don't change every year. They change every, 3, 4, 5 years or something, and they jump up in $500 increments.
I remember my foster mom had an IRA, I don't remember which one it was, but she could only do like 10,000.
Forever and ever and ever, it was $2,000 a year. And now it started to jump up because, believe me, $2,000 a year ain't going to get you retired. You do have until April of the next year. So I use this as a tax planning tool for clients. So if you come to me in 2014, like say Jess comes to me, she and her husband come to me. Oh, let me use somebody that's single. So Tirsa comes to me, and I do her tax return, and I'm like, you're getting back $1,800. Wahoo! And then the next words out of my mouth are going to be, can I have half of that to put into your IRA? No, she's going to say yes, because I'm a strong armor. So what I do is I get to take that $900 on her tax return, and then she gets the money back. Right? She gets her $1,800, and then she has until April to get the $900 that we put on her tax return into her IRA. And this is how I get my clients that don't fund their IRAs during the year to put some money in. Give me a piece of your tax return. Let's get it going on your retirement.
So then that 900 or whatever you put on there.
I've already written it off, so she's kind of committed. She signed her name to it.
If you're doing the Roth IRA,
Then it's not on your tax return at all. But, and I don't know Tirsa's situation certainly, but my guess is young person, not set to inherit a ton of money, she's going to be doing a traditional. I mean, I can't see any reason I would advise her to do a Roth. Okay, so Roth, now we need to kind of dig into our book, and this gets pretty complicated pretty quick, so put on your little thinking hats. So there's limits, and just like anything, these tools are really designed for lower and middle class or middle income people. In other words, if you're making $500,000 a year, the government's not interested in subsidizing your retirement contributions through tax write-offs. So let's take a look on page 4-19. What we're talking about here, you guys, are phase-outs for contributions. In other words, when your income hits a certain level, you lose the ability to write off contributions or to even make them. Okay, Roth IRA contribution maximum is reduced for all taxpayers over certain income levels. At the bottom of page 419, please circle or highlight that this is your Roth IRA phase out. It says it right in the title. 2014 AGI phase out ranges for Roth IRA contributions. So when you get to 114 grand of AGI or as single or head of household, you start losing the ability to make a full $5,500 contribution. If you're married filing joint, you got to be all the way up at 181. Why does the IRS care about this if you don't get a tax write-off for Roths?
Is it because when you pull it out, it's not
It's exactly it. All that interest that it's earned all those years, they never get a piece of it because it's not taxable, right? So I put in my $5,500 a year for 30 years. Boy, howdy, I'm generating some interest in there, right? And it's not taxable income because it's in your retirement vehicle. So what they're saying is if you're this high income, we don't feel as a government that we need to help you out funding your retirement. Traditional IRA, next screen. Contributing and deducting to a traditional IRA. Okay, first thing that you have to realize is you're limited in how much you can put into a traditional IRA if you also get to participate in an employer plan. What the heck does that mean?
if your employer has retirement.
It doesn't even matter. So I'm an active participant in my plan here, right? I put in money every month and the University of Montana matches me every month. So I certainly don't hit any of these phase out levels, but just pretend that I did. They're saying, listen, if you have the privilege of doing that, you don't also get to write off another $6,500 a year contribution to an IRA because you've got these other tax deferred plan going on. So here's the first thing. The amount you get to deduct is dependent on your AGI, right? How much do you make? And whether you or your spouse, if you're married, is an active participant in a plan at work.
So if your cousin A has a 401k and you participate in a 401k,
then you've got to worry about how much you can actually contribute to your traditional IRA. And not just if you are in it, Sarah, but say you and your hubby both work, you don't have a plan at work, but he does, that still might limit you. Okay, let's look at the rules. So if you're single, you're going to the top of page 420. And again, please highlight the title to this table, 2014 AGI phase-out range for traditional IRA contributions. So here's the question. I'm single and I'm in a plan at work. When do I start phasing out how much I can put in? 60,000. I'm married filing joint and neither of us are in a plan at work. No phase out. I'm married and my husband is an active participant in his plan, but I don't have a plan. No. 181 because I'm married filing joint. One person's an active participant, but I'm the what? I'm the non-active. I don't have a plan. See, I'm head of household, and I'm in a plan. 60,000. Okay, so let's try this in application mode. Okay, let's try this one. Owen is 42. He's single, and he wants to contribute the maximum to his Roth. His AGI is 118, so his contribution will be limited. The calculation here is that you lose dollar for dollar each dollar that he is over the phase out. Okay, so how much is his AGI? 118. Which chart are we on for a Roth? The one on page 419. When does he start phasing out? 114. And what's the difference between the high and low amounts in the phase out range for single? 15,000. Wait, where did we get 120? What's 127? The hell did that come from?
I think it's supposed to say 129. Yeah, it's 129. Is it or?
I don't know what this is. 127. He's single. Oh, help me out here. So we're on page 419, right?
Oh, that's the,
Is that a typo?
Shouldn't be 20.
I think this number is supposed to be 129. Right? Yeah, it must have been the prior year's number. Oh, yeah. I don't know what I've done here. Sorry.
Yeah, because it says 129 up there.
So 11/15. All right, so let's calculate then how much we think that he gets to write off. Or that he gets to contribute, excuse me. So the bottom number, yeah, that was right. I think I just screwed this one up. So 11/15 times 5,500. I don't have my calculator in here today. 11/15 times 5,500. I can't believe I didn't catch that. That's probably not the right number. $4,033. And then this one would be 11 divided by 15 times 6,500, 47.67. Okay, this is what I got now. Sorry about that. So the numerator is what's the difference between what he made and the highest end of the phase out? Because once he hits 129, it's zero, right? He can contribute zero. And then the denominator is the difference between the high and low in the phase out range. So did you get these numbers, 4,033 and 47.67? So 129 minus 118 is 11,000. 11,000 divided by 15,000 gives you some percentage of what he gets. He's hoping to contribute the full 5,500. No, he's limited to 4,033. I'll repost this. Sorry about that. And then same here, but once you're over 50 years old, you can contribute what? Another grand a year. So you can contribute up to 6,500. In this case, he gets to put in 47.67.
Over what age does that start?
Over 50. In the year you turn 50, you can put in an extra grand a year. Go ahead. Okay, I will repost this. I hope I haven't done this on all these. Okay, now let's try this one. Liza and Mikhail are both 41. They're married, filing jointly. Liza is covered by a 401k at work, and she makes 96 grand a year. Mikhail is not covered by a plan at work, and he earns 30. So first off, what table are we going to? Traditional. So let's flip to page 420. Are they single, head of household, or married, filing joint? Married, filing joint. Neither participant, one participant, or both participants? One, just Liza. But the question is, I want to know how much can she contribute and how much can he contribute? How much is their AGI combined? 126. Now let's look at the chart. Who do you want to do first, Mikhail or Liza? All right, let's do Liza. She is the active participant, right? So which one are you, what's the phase out for Liza? 96,000. So how much can she put in?
Isn't it for both their income?
Oh yeah, I'm sorry. 96 to 116. And their combined AGI is what? 126. So how much can she put in? Nothing. He's the non-active spouse. When do you start phasing out if you're the non-active spouse? 181. How much can he put in? 5,500. Let's see if I did this right. Okay, so since Liza is the active plan participant and their joint income exceeds the upper phase out, she may not make a contribution to a traditional IRA. She could, however, make $5,500 contribution to a Roth. Because if you flip back to 419, they don't hit the 181, do they? So that's the example of the kind of thing that you're not just a tax preparer, but you're trying to help them with life decisions. Like, hey, you can't do a traditional, but you can put your $5,500 into a Roth.
Can you have both a traditional and a?
Sure. But not, you can't contribute to both in the same year. But in this example, maybe she's got a traditional because she used to be lower income. Now she sets up a Roth and can start to fund that. Good question. Mikhail can make the full $5,500 since the AGI phase out for the spouse that's not an active plan participant doesn't kick in till 181. Okay, does anybody have questions on the deductibility of these things and the contribution amounts? So what happens when you take the money out of a traditional IRA? Okay, first off, you can't do it until you're 59 and a half. And you have to start doing it by the time you're 70 and a half. Why does the IRS make you start taking a distribution? Say you didn't need it. Say you'd funded an IRA your whole life, and then I actually had a client, this is kind of an interesting story, out of left field gets a phone call, hardworking gal here in Missoula, early 60s, single, gets a call. She's originally, her people were from Oklahoma years ago, from an attorney, found that she's a part owner in a oil and gas royalties in Oklahoma. And where should he send the check for $196,000 to? I mean, she calls me up. She's like, I don't know if this is a scam. And I'm like, well, give me the guy's phone number and da-da-da-da-da. And I call him up. He's a bona fide attorney. And they're people that go and, they're attorneys that go and look for unclaimed property. So if you don't claim something after, I think it's 6 months, it has to go to the state. And then these attorneys go in and they start combing these unclaimed property claims and trying to hook them up with people that own them, and then they take a cut of it. So the attorney made 60 grand. She got a check for 196. So maybe now she doesn't need to ever take her IRA distributions. Why does the IRS make her do that at 70?
So she can make that.
They want their cut of it, because if she dies with it and leaves it to her kids, it gets a stepped up basis and they never get a cut. That's exactly it. Okay, what if you get into your IRA before you're 59 and a half? I lose my job, I've got 50 grand in there, I can't pay my bills, I start to raid my 401 or my IRA. What happens? Taxable income plus 10% penalty. Except for if these are one of your rare situations. I become disabled, they'll let me in to my IRA. Still taxable income, but I don't have to pay the penalty. I don't even know what this is. I'm a first-time home buyer and I need up to 10 grand for a down payment. I'm paying higher ed expenses for myself or my dependents, or I've got really high medical bills. Then they'll let you into your IRA, penalty-free, but it's still taxable income.
So do they take out the taxes themselves, or do you just have to report it yourself?
It depends upon who your carrier is. That's a really good question. And I don't know if I'm answering this correctly. I think now that they've got to withhold 20%.
Okay, because when my husband, well, he didn't have an IRA, it was broke. So it might be different.
Same. No, same.
Okay.
I think it's 20%.
Because he was disabled, and that's why he was pointing it out, and they were saying, well, you're going to be.
Well, you still have to
taking
pay
all this money out, and
You do, but you still have to pay tax on it,
Right.
Sarah. All I'm saying is you don't have to pay that 10%.
It'd just be interesting to find out.
It is a 20% backup withholding, but you're going to owe tax on it.
Right.
So they're holding it out before you get it.
Okay.
Roth. Am I paying tax on my Roth when I get my money? No, because I didn't get any benefit of tax write-off when I put it in. It's tax-free as long as it was open for 5 years. And basically I waited till I was 59 and a half. That's all I want to say about that. These laws are extremely complex. But on the whole, if you wait till you're 59 and a half and you've had it for 5 years, your Roth is tax-free. I will tell you, this isn't actually very good tax planning, but I've done Roths for us because I don't want to worry about taxes when we retire. We're not going to inherit. We're not going to be in a higher tax bracket. It actually doesn't make theoretical sense what I've done, but I just don't want to worry about taxes when we retire. I think that we're going to be really strapped, and I don't want to have to worry about making quarterly estimated payments. I know, exactly. I can plan exactly what our retirement income is going to look like. It doesn't matter what happens to tax law. I've got it in a Roth. We're not going to pay tax on it when we pull it out. Okay. I'm not going to spend a whole ton of time on this, but there are a ton of vehicles if you're self-employed to fund your retirement. There's SEPs, there's SARSEPs, there's Simples, there's Roth 401ks, there's Keoghs. There is a plethora of instruments, and they all have different limits and different rules. I'm not going to ask you to memorize those, or certainly not to memorize them. But what do you need to know? You need to know if you move into some sort of tax practice that if you're self-employed, and honestly, this is what I do with my self-employed people, I tell them I don't do pension plan administration or pension planning. You need to go to a pension planner, and I'll get it in the tax software. But it is so complex that as a CPA, that's just out of my purview. Keogh, you can put in up to 52 grand a year, so you see a lot of like docs, orthodontists, realtors are using this, really high-income self-employed people. SEPs, again, this is a type of self-employed pension plan. Okay, so what have we talked about and why are we, so there's so many things there. So first we talked about IRAs. Let me just make this crystal clear. Does your employer set that up or do you set that up? You set it up. So you go to work for somebody and they don't have anything, are you just like, oh my gosh, I'm shit out of luck as far as funding retirement? No, you set up an IRA, okay? The ones that we just looked at are all for people that are what? Yeah, but self-employed. This KEO and the SEP and those are for folks that are self-employed. I don't have an employer. These now that we're looking at are employer plans, qualified retirement plans. What's the most common retirement plan if you go to work for somebody? 401k. And I don't know if I've even got that here. 401k. For a nonprofit, they're called a 403b. That's what we have here. 403b is just a 401k for a government or a nonprofit agency. Okay, so how does this work? So my boss isn't a good example because we're nonprofit. Let's say that I work for Montana Rail Links, and they match me dollar for dollar my 401k every year. What do they get to do with that amount they put into my retirement as far as tax treatment?
Don't they get to write it off?
Yeah, it's a deduction for them. Does it show up on my W-2 as taxable income? No. So can you see how tax favored it is by the IRS? Why? Because it's highly desirable for employers to help people save for retirement. So the IRS makes it a win-win-win every which way. Contributions are tax deductible. Employee contributions, if I put money into it, are pre-tax. The earnings is, all the tax on the earnings is deferred. In other words, I don't pay a tax bill every year as I earn interest on it, do I? No. So that's deferred way into the future. And it doesn't show up on my W-2. For a plan to be qualified, i.e. compliant with the Internal Revenue Code, it's got to be, non-discriminatory, and there's got to be minimum vesting. I mean, there's a lot of very stringent requirements. So if you're going to set one of these up at your job, you call an attorney and say, I'm writing a 401k plan, I need help. How much can you put in a year? This 25% or 52,000 is if you have a defined contribution plan. Those are fairly almost obsolete. 401k is really the vehicle. And right now, this amount goes up every year. You can put in $17,500 a year or $23,000 if you're 50 or older. Well, I can tell you, most people, what they make in Missoula, you're not taking $17,500 out of your income. What do financial planners tell us the minimum amount is as a percentage of our gross income that we should be putting away?
10%?
18. And if you're these kids' age, it's 23 because they're planning on no Social Security. So I remember when we first started out, 2 little kids, student loans, car payment, the whole 9 yards. And we heard that number and it's like, oh, we're just going to be big people. I mean, 18%, are you kidding me? Right? Oh, and by the way, you should be funding your kids' tuition accounts. And it's like, I'm trying to keep the heat on, So my best advice, and I'll say this over and over, and if you've had me before, you've heard me say this over and over. It is not important how much you fund. It's important that you start funding something. And if that means $5 a week, $20 a month, do it. Because what it does is it gets you in the habit of something coming straight out of your check and going somewhere else that you never see. And both of my kids have fought me on this. They're 23 and 26 years old, and I've already got them funding their 401ks. And they're like, are you kidding me? We're broke. They have student loan payments, all the same things. Okay, you do without 5 beers a month, and I'm putting that $25 a month in your 401k, right? That's what you do. So the point is, it doesn't matter how much, just do something.
So when you go to set up like your own Roth account and whatnot,
Yeah.
do you do it through the bank? Do you
Yes,
do it-
yes. And here's the other thing. My point is there's so many impediments to young people looking to do this. First off, I don't know how. Second off, 18%, right? Why bother, right? All those things. You go to the bank, and what they're going to tell you is, oh, sure, Jess, I'll set you up a 401k. It's a $5,000 minimum buy-in. Huh, well, let me get my checkbook. So what do you do? What do you do if somebody says there's a $5,000 minimum buy-in or a $2,500 minimum buy-in?
Make payments?
Huh? Yes. Well, You could take a loan. You could take a loan and make that buy-in. But what we did, because back when we started it, it was $1,000 minimum buy-in, which was like $5,000 now. We didn't have any $1,000. Is we started doing monthly pulls out of our checking account into a savings account that we just put over there and pretended didn't exist. And when we got to the $1,000, we bought into our first IRA. And your banker will help you do that. If you've got a decent banker, your banker will help you do that. Because they get it. Everybody started somewhere. And nobody starts with the 18%. Okay, and what happens when you pull money out of a 401k then? Why?
It's pre-tax when it goes in.
Exactly, and that's always a theory. Pre-tax going in, taxable coming out. Roth, no tax benefit going in, no tax coming out.
So they want their tax somewhere.
You get taxed somewhere, of course you do. And tax theory always says you'd rather pay tax later rather than sooner. But do you know what the tax rates are going to look like in 20 years or 30 years? Do you know what your health situation is going to be like? You know, I sure don't. So there's also a Roth 401k that works just like what we looked at, but obviously opposite of that. This is interesting. This was Obama's one of Obama's plans to get a saving. It's called the Low Income Retirement Credit. And if you take a peek on page 4-26, I always forget about this till my software pops it up. If you've got a client down on the bottom left-hand corner of 4-26, if you've got a client who's married filing joint and they make under 60,000 AGI and they put money into a retirement plan, they're going to get a tax credit. And if they're head of household and they make less than 45, or they're single and they make less than 30, the government is going to subsidize their retirement contribution. It's a tax credit, and you can see that it can be up to half of what you put in if you're pretty low income. So where does that show up on your 1040? Let's take a look on page 446. Where does that low income retirement plan credit show up?
Is that line 51?
It is line 51. And it's treated just like any of your other credits, child tax credit, anything like that. It reduces your tax bill.
Does that have to go specifically into a retirement account?
It does. It does.
So let's say you retire from the government. So,
Distributions, you mean?
let's say when I retire,
Yes.
I'm gonna get retirement from the government.
Yes.
I still use this.
Of course. And you should. Well, when you're working full time. Nobody's putting money away as a student. But when you're working, yeah, you absolutely should. Okay. Last concept, and then we're going to start on our manual recaps. What happens? I leave University of Montana. I go to work for University of New Hampshire. They've got a pension plan. I don't want pension plans all over the place. I want them all consolidated. Yep. So I call my trustee at the University of Montana and I say, transfer it all to the University of New Hampshire's plan because I want it all consolidated. The money goes straight from plan 1 to plan 2. I never see it. No big deal. No tax ramifications. And I can do that as many times a year as I want. I don't know who would be doing it many times a year, but there's no tax ramifications because you never see the money. It goes straight from point A to point B. It merges. It stays in the same sort of vehicle or instrument. No big deal. Nothing to report.
But if you have a 401k that was, that your employer contributed to, don't you usually have to work there for a certain amount of time before they'll?
That's a really good question, Jess. What's she asking? We talked about this in payroll. She said if you have a 401k and your employer matches, don't you have to work there for a while? What's that concept?
Being vested?
Vesting, exactly. How does that work?
The first time for like every year.
It can be. After 1 year, you're 20% vested. After 2 years, you're 40% vested.
That's how much of their contribution you get to take.
Very good. Excellent. That's exactly what it is, Jess. You get a percentage of the amount the employer put in, depending upon how long you've been. How about your own money that you put in? You always get all that. How about the interest your own money earned? You always get all that. When do you have to be fully vested by? 6. You have to be fully vested in 6 years. And I will tell you really, in all honesty, most plans now have pretty aggressive vesting schedules, particularly like, and not to keep using examples, but I know them because they're my kids. Like Dylan works in San Francisco, and young talent there's such a competition to get young talent in the Bay Area that their vesting schedules are 100% immediately. Because young people transfer jobs so fast, they won't even dream of going on with somebody unless they're going to get all their retirement when they split in 18 months. So you have to do that.
Does it work the same with private retirement accounts? Like if I bought one that was from like a credit union, bought it the one here in Montana, in Washington, would I transfer it or would I keep it just here?
So I'm not sure what you mean bought into one at the credit
Like if
union.
I got a 401k through my credit union at the bank.
You wouldn't get a 401k through your credit union. You only get a 401k through your employer.
If I got like an IRA.
That travels with you wherever in the world you go. That's yours. It belongs to your social security number. That's not affiliate. That's not this. That's not a retirement plan. That's an individual retirement account. Do you guys understand the difference between these things? It's quite complicated, actually. An IRA, any of you, if you earn any money right now, could set one up. It's limited to $5,500 or 100% of earned income. So say your wife's a neurosurgeon and she's making $500,000 a year and you're working a little bit on the side making a couple $1,000 while you go to school, you could fund that. $2,000, your IRA. He can't do a 401k because it doesn't have an employer that does that. Okay, so you've got to have an employer that's got a retirement plan. Okay, here's where people get into a ton of trouble, and it just pisses me off that retirement plan trustees don't tell people this. Hi, I'm moving to the University of New Hampshire in Manchester, and I want my $180,000 that I've saved to go to New Hampshire. They cut me a check, and then I'm going to take it to New Hampshire and deposit it with my new people. But do I get the $180,000? No, they are required to hold a 20% backup withholding. The trustees here. So they don't send me $180,000, they send me 80% of $180,000. But guess what I have to do?
Wait, the full 180?
I have to get the $180,000 to plan 2 within 60 days. So I've got to come up with $36,000 on my own. Let me get my checkbook. So it's so ridiculous. If you are transferring money from one retirement plan to another, and I don't know why they don't tell people this, you're not going to get the 180 in a check to carry nice and neatly to the second guy. You're just not. They're going to back up mandatory withholding at 20%.
Do you get that 20% eventually?
Sure, when you file your tax return, well, a lot of good that's going to do me.
There's no way that you'd be able to, most people wouldn't be able to afford to.
Of course
make
not.
That 20%.
But no, of course not. So why these plan trustees don't say, oh, by the way, you know you're not going to get 180, you're going to get 180 minus 36, right? But you've got to get the 180 back to the University of New Hampshire. They don't tell them that.
Check like that, do you have to pay taxes on the amount that you took out? Like, is that a taxable distribution?
Exactly. The portion of the plan not transferred is subject to tax and penalty. I mean, it is the screwiest thing, and I've seen it happen to clients.
But you're just moving it, you're not getting it.
I know.
So the 36,000 is taxable?
Yes.
So if you're
Not really. Well, yeah, the way around it is option number one. Call your trustee, please let me get you all the information and just directly wire my transfers.
So
To-
that's the best way to do it.
That's the only way to do it unless you're daft. I mean, it's just, you just end up screwed.
So don't let them send you a check.
Huh?
Don't let them send you.
Don't let them send you a check. The reason the government does this is that people are like, I'm going to get that $180,000 and I'm going to put it in my glove box, and then when I get to Manchester, I'm going to take it out and take it in and deposit, and guess what happens on the way?
You spend it.
You know, you don't end up with 180. You know, you spend down 20 of it. And so they're saying, no, we're going to take our tax cut right off the top. Don't do that. Don't get the check.
But so when you're doing the direct transfer versus the rollover, the accounts before and after can still be the same. It's just the manner of how you get it.
Yes, totally, totally. Okay, let me shut down the recording and let's take a look at our cases for this chapter.